Let me ask you a real direct question. Is your traditional investment portfolio actually safe? For decades, we've all been taught a very specific set of rules for growing and protecting our wealth. We've trusted the standard models, but what if the very foundation of those models is cracking under the pressure of a changing global economy?
Negative 17.1%. Let that sink in for a second. That is the real return loss that the traditional 60-40 portfolio, the classic 60% stocks and 40% bonds, suffered in 2022. During the last major inflationary era, this exact same setup saw 7 whole years of negative real returns. It's basically the ultimate proof that the old model, the one we've literally all relied on, is fundamentally broken in today's macroeconomic environment. So, welcome to today's Explainer. Today, we are diving deep into the new 60-40 portfolio, navigating the macro shift. Based on the super comprehensive In Gold We Trust 2026 report and some other leading institutional analysis, we're going to unpack the exact blueprint designed to protect your purchasing power in a structurally altered world.
Here is our roadmap for today. We've got 1, the old 60-40 is failing. 2, the return to hard money. 3, blueprinting the new 60-40. 4, defining the real assets. And 5, the inflationary future outlook.
All right, let's jump into section 1. The old 60-40 is failing, a broken model.
We used to believe government bonds were this completely sacrosanct, risk-free asset class that perfectly hedged against stock market drops, right? Well, the present reality is a whole lot harsher. We're actually seeing a positive stock-bond correlation right now. That means stocks and bonds are dropping at the exact same time, which is severely pressuring real bond yields.
The absolutely crucial point here is understanding why this is happening. We're facing excessive global debt levels, structurally higher inflation, and fiscal dominance. Analysts are actually calling this the era of the debasement trade. The waves of inflation we've seen recently totally prove that price stability is no longer a given. Relying purely on nominal claims, like fiat currencies and government bonds, poses the very real danger of a lost decade for wealth preservation. Nobody wants that.
Moving right along to Section 2, the return to hard money, a paradigm shift.
There's this fantastic quote from Ronald Peters Stofferle, one of the primary authors of the In Gold We Trust report. He says, "The future of money lies in its past." And he hits the nail on the head. The system established back in 1971 is showing severe signs of fatigue. What we are witnessing today is the creeping remonetization of gold, acting once again as a completely neutral store of value.
To really see how we got here, we kind of have to look back. In 1971, the Bretton Woods system ended, which kicked off the modern fiat regime. Fast forward a bit to 2008, the post-global financial crisis environment introduced unprecedented quantitative easing. Then by 2020, central banks responded to global stress with massive, and I mean massive, liquidity injections. And today, in 2026, analysts describe our current era as the interregnum. It's this volatile transitional phase where the old monetary order is losing stability, and that is exactly what's driving a structural remonetization of hard assets.
If you take away just one thing from this, make it this. We are in the middle of a massive paradigm shift. Non-inflatable assets are no longer just cute little alternative satellite investments you sprinkle into a portfolio for some flavor. They are evolving into core investments. They're literally the new foundation required to protect your purchasing power when trust in fiat systems starts to waver.
Okay, let's get into the mechanics. Section 3, Blueprinting the New 60-40, the Modern Model.
Check out this modernized portfolio model that steps away from those risky nominal claims. The craziest part? The bond allocation has absolutely plummeted down to just 15%. That space has been completely repurposed for non-inflationable real assets. We still keep 45% in stocks, but the remaining 40% is now this incredibly diversified basket of hard money and strategic resources.
So the exact target allocations break down like this: 45% stocks, 15% bonds, 15% safe haven gold, 10% performance gold, which includes your silver and mining stocks, 10% commodities, and finally, 5% in Bitcoin. Think of this as your new mental model for a financially resilient future.
And out in the real world, the gap is just widening. From 2024 to 2026, the new 60-40 model is vastly outperforming the traditional allocation. By swapping out those vulnerable bonds for real assets, this new portfolio doesn't just protect you against inflation, it actually captures the upside of a changing global economy.
Section 4, Defining the Real Assets, the Hard Money Core.
Let's break down exactly what these assets do.
First up, we've got Safe Haven Gold sitting at 15%. Its role is simple but totally profound. It's a non-inflationary, completely neutral store of value with zero counterparty risk. Gold acts as the portfolio's ultimate stabilizing anchor. I mean, central banks can't just print it out of thin air, right? In periods of fiscal and geopolitical instability, it is the bedrock that holds your purchasing power steady.
Next is what we call performance gold and commodities. This encompasses your silver, mining stocks, and strategic resources. Think of this as the industrial anchor of the portfolio. Silver isn't just for jewelry anymore. It's being driven by massive industrial demand, actually hitting a record 1.12 billion ounces recently. That demand is largely fueled by solar panels and electric vehicles. And get this, despite this exploding demand, energy and materials companies currently make up less than 6% of the S&P 500, which gives them incredible upside potential. Then we have the 5% allocation to Bitcoin. Institutional analysts are no longer viewing Bitcoin as just some speculative tech play. No, they see it as a digitally scarce, non-inflationary asset. Because it's highly mobile and operates outside the traditional banking system, it adds high convexity, meaning rapid, explosive upside potential to the broader portfolio.
Now, I hear this all the time. People ask, aren't gold and Bitcoin rivals? Well, the data actually suggests they are a pretty powerful symbiosis. Gold provides that deep monetary stability and thousands of years of history. Bitcoin, on the other hand, provides monetary optionality and technological innovation. Together, they form this unified front of scarce assets that complement each other perfectly within the new 60/40 framework.
Okay, bringing us to our final part, Section 5, the inflationary future outlook, long-term projections. So what does this all actually mean for the future?
Just consider this completely staggering math for a second. The global bond market is roughly $140 trillion. The investable gold market, it is tiny in comparison, sitting at just $15 trillion. If institutional investors decide to shift just 2%, literally just 2% of their capital out of bonds and into gold to protect themselves, that represents a $3 trillion move. That single move would swallow 1/5 of the entire investment gold market. The impact on real asset prices would be absolutely monumental.
And that exact dynamic leads us to a pretty shocking projection, $8,900 an ounce. The conservative 10-year target of $4,800 for gold, yeah, that's already been breached in this dataset. With these structural remonetization trends and the ongoing inflationary environment we're living in, institutional models are now increasingly turning to this $8,900 target for the end of the decade.
We've seen exactly how the old assumptions are falling apart, and we now have the exact blueprint of the new 60/40 portfolio designed to actually thrive in an era of hard money. So I'm going to leave you with this final provocative thought. Knowing all these tectonic shifts happening right now across global markets, is your wealth truly positioned for the monetary future?